Good morning, everyone. Welcome to this webinar on LBTT and ADS. My name is Bob Langridge, and I'm a partner here at Brody's. So we'll kick off. As I said, this is an LBTT and ADS update, and I'm joined by Isabel Denverno, Director of Corporate Tax here at Brody's, and Scott Bell, who is a Senior Solicitor in the Corporate Tax team. And I will hand over to Isabel, first of all, who's going to talk about some of the general updates with LBTT and the new consultation that is going to be launching shortly. Isabel.
Thanks, Bob. So I'm going to speak about various current developments. The first one is just a reminder that we're going to have a UK spring statement on the 26th of March. Originally, the new Labour government said that they would only have one fiscal event each year, but now there do seem to be sort of suggestions that there could be some tax changes announced at the UK spring statement next week. So it's just worth bearing in mind that if there are any changes to SDLT, even though that's probably quite unlikely, if there are, the Scottish Government might need to respond to those and make a similar change, just because of the way the block grant adjustments work, which nobody really understands how the block grant adjustments work, but it is really a question of if the UK raises a tax, then if the Scottish Government don't do a similar increase, they'll be sort of out of pocket in terms of the money coming from Westminster. So that's just a warning that something could happen as a result of the spring statement next week. I'm also going to mention the Scottish Government tax strategy, an upcoming review of LBTT, the fact that the Revenue Scotland website is being revamped with effect from sort of the 1st of April, as we understand it. Nothing is going to have changed in terms of content, but the format of the website will change. But if you can't find things on the website following these changes, then do get in touch with Revenue Scotland or with one of us, because Bob is currently the convener of the Law Society's Tax Committee, and I'm a member of it. So we do have constant meetings with Revenue Scotland to raise points like this from practitioners. I'm going to mention also some issues with the 3-yearly lease review returns and with the SETS messaging system. So if we move on to the next slide and the one after that, there has also been the publication of the Scottish Government's tax strategy, which was published on the Scottish Budget Day on the 4th of December. To be honest, this slide isn't a mistake that I forgot to finish the bullet points. It's really that there isn't a great deal to say coming out of the tax strategy, apart from the fact that there's going to be a Scottish tax conference in 2025, which is probably a good thing and might well be worth going to. But the tax strategy didn't really set out any kind of roadmaps or things like that. So it's a difficult thing to write a tax strategy when the taxes that you're dealing with are LBTT, landfill tax, and the Scottish rates of income tax. But anyway, there's nothing that really affects us in the tax strategy, I don't think. Moving on to the next slide. Review of LBTT. This is more important. It was announced at the Scottish budget, and it is a sort of full review of most of LBTT, but we can't expect immediate changes. the idea is that the Scottish Government will carry out this review, and the end product will be recommendations for consideration by the next Scottish Parliament after the election, because the last date for the Scottish Parliament election is May 2026, so there wouldn't be time to put any of this into effect. But what can we expect? Well, one thing we might expect is the abolition of multiple dwellings relief. The SDLT multiple dwellings relief was abolished last year. The Scottish Government didn't follow suit, but it's an obvious one for them to look at. The treatment of mixed purchases is another one. At the moment, if you're buying a mixture of residential and non-residential property, it's treated as non-residential and is subject to LBTT at the non-residential rates. And that can mean that a very small amount of non-residential property included in a purchase with a very large amount of residential is still subject to LBTT at a much lower rate, which in some ways doesn't seem fair. And it also makes people really sort of stretch the boundaries a bit to include non-residential items. One solution would be to have an apportionment system. We already have this for ADS, because when you buy a mixed property, if it includes dwellings and ADS is payable, then we pay ADS on the price apportioned to the residential element. So that would be certainly possible for Scotland, because, as I say, we already have that for ADS. But it's these kind of things that may come out of the review. 3 early lease reviews is certainly an area that the Scottish Government want to look at. I personally think it would be good to have a de minimis limit, so that smaller leases didn't have to bother doing 3 yearly lease review returns. I certainly think there ought to be a change to the penalty regime, because, as people may well have experienced, if you don't submit one of these 3 yearly lease review returns, even if there's no LBTT actually payable, then penalties are charged, and the maximum penalty can be up to £1,600. And if there is LBTT payable, then it means that there's a late payment penalty as well as a late return penalty. So a lot of penalties for the 3 yearly lease review returns. I think when it was discussed before the introduction of LBTT, the understanding of it was that you wouldn't actually have to do a return if nothing had changed, but that's not how it turned out. Anyway, moving on to the next slide. We're aware of a few issues with the online tax system, which I'm sure others have experienced, and which Revenue Scotland are hopefully addressing. So when you're doing a 3 yearly lease review return, the information relating to the lease gets pulled through from previous returns, but it cannot be amended by the agent. So, for example, if the tenant's changed its name or its registered office or something like that, you can't change that in the 3 yearly lease review, because the information is being pre-populated. So similar things where there was some kind of error in the previous returns, that can't be changed by the agent. And we've had a few where a pre-1st April 2015 start date had been included, which you used to be able to do at one point, but you can't now. So this means that you have to kind of do a draft return and send it to the client saying, I'm sorry that this return has got the wrong name on it, or the wrong registered office, but we can't change it. We'll have to get Revenue Scotland to change it after the thing's been submitted. Also, there's been a move towards by Revenue Scotland to only dealing with taxpayers and so on through the SETS messaging system, but equally there have been issues trying to upload documents to the SETS messaging system, and quite a lot of documents it won't upload and so on. And there's also difficulties downloading the SETS messages to your own document management system. Moving on to the next slide. There are going to be quite a few changes to SETS. For example, they are introducing a live link to Companies House, which should update company names and registered offices. Then the updated SETS system will mean that longer document names can be accommodated, and SETS messages will be easier to download and more easily searchable. And to be honest, Revenue Scotland do seem to be quite keen to change things to make things easier for taxpayers and agents. So, and they can introduce changes a lot more quickly than HMRC can, for example. Moving on to the next slide. Linked leases. This is where you have leases between the same landlord and tenant or connected parties, which are part of a single arrangement. And the way this works for LBTT is that you only have a single nil rate band. If the leases are granted at the same time, you can submit a single LBTT return, but this makes it difficult to deal with the situation where one of the leases is terminated. So generally, we would advise doing separate leases for separate returns for each lease. But if there are, for example, 10 linked leases, then there's quite a lot of putting in of returns that has to be done, because each time a new lease is granted, that changes the computation and affects the LBTT payable, probably only by a very small amount. We have been in the habit of actually just amending returns that had already been submitted if you were within the 12-month period. But Revenue Scotland recently made us unamend the returns and submit further returns. The trouble is that, if you're moving on to the next slide, if you have 10 leases, for example, you end up having to submit 55 LBTT returns, and also the problem arises as to how do you do the 3 yearly return, because you've got loads of different LBTT returns, and it's a bit difficult to know which one to pin the 3 yearly return on. Other workarounds people have used, apart from just amending the returns, is to allocate the whole of the nil rate band to the first lease and then pay full LBTT on the other leases. That can work, and actually Revenue Scotland do agree to that sometimes if you ask them. This is not just a linked lease issue. In fact, it also applies to linked purchases. Revenue Scotland are now looking at this because they accept that it's a bit of a compliance nightmare to have to submit so many returns. Moving on to the next slide. Another question that we are trying to get to the bottom of is if you have 4 linked leases granted at the same time, so you've got the 1 nil rate band apportioned between all of them, one of them's renounced before the 3 yearly review, and so you only have 3. How do you do the 3 yearly review return for those 3? Do you just apportion the LBTT payable between the 3 remaining leases, as if there'd only been 3 from the beginning? Or do you have to somehow include the terminated lease in the correspondence? We've actually asked Revenue Scotland this question, and only this morning, one of the Revenue Scotland officials came back and said that in their view, you just ignore the 4th lease that's been terminated. So when you get to the 3 yearly return, you just deal with it as if there are 3 leases, and that's the end of the story. Anyway, we'll probably have to check that out with numbers before we adopt that on a general basis. But it just is amazing how many issues are still remaining to be addressed, even 10 years after the introduction of LBTT. All right, moving on. I'm now going to hand over to Scott, who's going to talk about the ADS changes in the budget. Scott.
Thank you, Isabel. Yes, so as we probably most of us are aware now, the ADS rate increased from 6% to 8% for transactions entered into on or after the 5th of December 2024. There are some transitional provisions which say that if you entered into a contract before that date, the old rate of ADS will continue to apply even if completion occurs after the 5th of December 2024. Not sure how useful these will be now, sort of three months on, given that I suspect it's probably not that common now to be resting on this for that long. But the transitional provisions are there and useful to be aware of. And this is the second 2% increase in the ADS rate in as many years, with the previous increase coming in December 2022 when the rate rose from 4% to 6%. So in the space of just 2 years, the ADS charge has effectively doubled, and you would pay twice as much ADS on an equivalent purchase in 2024 if you had bought it in 2022. So moving on to the next slide, we're just going to have a talk about perhaps why this change has been introduced. And if you look at the Scottish Government's tax strategy report, much like Isabel's slide on the Scottish Government's tax strategy report, it doesn't say very much. So there's nothing really in there that explains the kind of rationale or the objectives associated with this increase, but they have said elsewhere that firstly, it's obviously intended to raise revenue, unsurprisingly, and also to protect first-time buyers. So if we look at those two things separately, the Scottish Government said that they expect the increase in the rate to raise around £30 million in each of the next 3 years. What's unclear is whether that accounts for, or whether they have considered the fact that there's likely to be a loss of revenue set against that by virtue of the fact that people will be dissuaded from entering into transactions because of the increased rate, and therefore you're going to have less LBTT and ADS that would otherwise have been charged, albeit the ADS would have been at a lower rate. So it's not clear over the long term how those two sort of competing things will net off against each other. But ADS has always been, as we sort of all know, a controversial and unpopular policy in the sector among landlords and residential property investors. And that's often been one of the common criticisms of ADS as a whole. And in terms of protecting first-time buyers, yeah, fair enough. Potentially, it's likely to discourage people from acquiring second properties and increase owner occupancy. And it will discourage people from making sort of speculative property portfolio acquisitions. And the idea is that I suppose that this will boost housing availability and make it easier for first-time buyers to get onto the property ladder. Another criticism which has been present throughout the existence of ADS is that when you increase the cost for landlords, this will ultimately be pushed down to the tenants. So those that are currently renting will find it harder to get out of it and onto the property ladder. There's also a suggestion that the fact that it's more expensive to acquire these additional properties will reduce the number of transactions between landlords, which will make the whole rental sector essentially less efficient, with properties not ending up with people who either value them the most or in the best position to use them and make them available to those that wish to rent. The third point here, and Isabel mentioned it earlier, is to do with the block grant adjustments. So essentially, the block grant that the Scottish Government receives, as Isabel kind of explained, will be adjusted where the UK government increases a tax for which the Scottish Government has a sort of devolved equivalent. So where the equivalent UK tax is increased, there's a downward adjustment in the block grant that the Scottish Government receives. And effectively, it's like saying, this is what you would have got had you not had the devolved powers, and it's over to you, being the Scottish Government, to make up the gap using your devolved equivalent tax powers. So the recent ADS increase in December there was likely a response to the increase in the HRAD, which is the high rates for additional dwellings, which applies to SDLT, so in England and Northern Ireland. And that was increased in October 2024. And so it's a pretty safe bet that the most recent ADS increase is a response to that, and that perhaps distinguishes it from the previous increase in December 2022, which was probably just a pure revenue raiser. So whether that indicates that there's not necessarily a committed trend here of increasing the rate over time, who knows? We don't really have any long-term forecast from the Scottish Government, which gives us an inclination as to where it's likely to go in sort of future years. And moving on to the next slide, please. So this graph here is just quite a good illustration, really, of the difference now as between a person buying a second property to which the ADS charge applies, or whether replacing their main residence, or they're a first-time buyer. And you can see that really, regardless of the price, by the way, this chart shows the LBTT and the ADS table, but really, regardless of the price, an 8% additional charge is a lot. And I don't know if we'll have any of rural land agents on the call, but it certainly seems that, and not that this will be the top of everyone's priority, but when you think of very high value residential dwellings like rural estate properties, often these are purchased by international buyers or buyers from down south who certainly won't be replacing their main residence, and so will be within the charge to ADS. And I mean, already invariably when we're instructed by these kind of clients, they're kind of awestruck by the fact that we have this ADS charge, and I'm sure that the increase to 8% is only going to make it it's even more of a bitter pill to swallow. And if you've got these international buyers that are shopping around and considering in which location they want to buy their large estate home, it must put Scotland at a disadvantage. It would be interesting to hear if any agents are already kind of experiencing that. And just on to the next slide, please. So a final point to mention about the rate increase is that it sort of worsens the sort of strange anomaly or absurdity that exists in the legislation. And that's to do with the 6+ rule, which many of you may have heard of. And essentially what that is, it does two things. If you acquire 6 or more dwellings in a single transaction, that transaction is treated as a non-residential transaction for LBTT purposes. And two things that flow from that are that the non-residential LBTT rates will apply, even though the transaction comprises only of separate residential dwellings, and the non-residential rates are, of course, much lower. And it will also switch off the ADS charge. So if you buy 6 or more dwellings, ADS won't apply regardless of how many dwellings you already own, or if you're a non-individual, it won't apply. So just looking at this example here, if there's a total purchase price of 1.5 million, and here we're just saying it's a non-individual buyer, meaning there's no chance of there being a replacement of main residence exemption. If acquiring 5 dwellings, applying the residential LBTT rates and ADS at the new 8%, the total tax charge is £143,000. If you're fortunate enough to be able to acquire just 1 more dwelling, you would switch off the residential rates and switch off the ADS. And after a multiple dwellings relief claim, you can see that the total tax there is minute by comparison. So it really is quite a sort of ridiculous outcome when you consider that the only difference is 1 extra dwelling. So the 6+ rule is even more advantageous to those that are in a position to acquire more than 6 dwellings in one shot, and equally the flip side is it punishes those that want to invest in residential property but can't necessarily satisfy that 6+ rule. So on to the next slide. I'm just going to have to speed up, I think. I'm going to talk through some of the other changes to the ADS rules just at a high level. These were introduced last April, so many of you might already be familiar with them. And indeed, Bob and Isabel and Alan Barr did a webinar on these changes probably around this time last year before they came in. The main changes are to the way the replacement of main residence rules work. The first thing to mention is that the time limits have been extended. So essentially now, if you acquire a new dwelling and you have disposed of your prior main residence, and that can be either in 36 months before you acquire your new main residence or in 36 months after, you won't be subject to the ADS charge. Obviously, to clarify, if you dispose of the dwelling before you acquire the new dwelling, you won't pay the charge at all. And if you dispose of the old main residence in 36 months after you've acquired, then you'd be entitled to recover the ADS. So doubling the time limits effectively is fairly rare. I think that the 18-month gap would even catch that many taxpayers out. There were issues, I think, with COVID and things like cladding that have caught some taxpayers out and prevented them from claiming the relief or repayment. But 36 months is certainly very taxpayer friendly, and 3 years essentially you have in order to say dispose of your old main residence and recover the ADS. So I suspect that will help a lot of people out, and if not, completely eliminate situations where people are just on the wrong side of the rules. And onto the next slide. And it's important to note that the new time limits only apply if you buy the new main residence on or after the 1st of April. So if you buy your new main residence, if you had purchased your new main residence before that date, you'll still be subject to the 18-month tail rather than the 36 months. So you have 18 months from the 1st of April or the date in which you acquired in order to dispose of the old one to make sure that you can reclaim. And next slide. I'm really going to skim over this. This again, the changes to the joint buyer rules and single economic unit rules again relate to where couples or joint buyers are buying a new dwelling together and they're seeking to rely on the replacement of main residence exemption. A couple of things to say is that these rules were always complicated and misunderstood. And although the changes do appear to have achieved a better situation for taxpayers, and they've got rid of some of the kind of unfair outcomes that were possible under the old rules, the actual amendments are very complicated and arguably make the legislation even more dense and difficult to navigate than before. They've kind of taken a bit of a machine gun approach to trying to solve the problem, and have made lots of changes to lots of different provisions. And some of these we think are either completely ineffective or are superseded by other changes, or even cancel one another out. But one of the key takeaways is that the changes have been taxpayer friendly and have improved the position. I'm definitely not going to go into a full analysis of the changes, and so I will kindly refer you to an article which Bob wrote around this time last year, where he walks through all of the amendments that were made. And whilst it's quite an unpleasant experience to read through that article, at least the first couple of times, if I may say so, it does actually highlight just how ridiculous some of the amendments are, and gets you thinking, well, perhaps there was an easier way to solve the problem. And if we just jump to the next slide, just going to explain the sort of key operative change really quickly, and there are more to the amendments than this, but I think for practitioners who are maybe on the call and are going to have to be hands-on with these rules at some point, I think this is the kind of key bit. So the problem really could be summarized that where a couple or joint buyers were buying a new main residence, the default under the old rules was that all of them would have to meet the replacement of main residence conditions. And there were some carve-outs for buyers in a single economic unit, but the default was pretty rigid and could throw up some weird and unfair outcomes. So this new paragraph 81D basically says that where there are two or more buyers who are or will be jointly entitled to the interest acquired, each of whom own a dwelling, or dwellings other than the one that's the subject matter of the transaction, all of the buyers must meet the conditions specified in this subparagraph. So basically, the first question to ask is, what do each of the joint buyers own, and do they actually own other dwellings in their own name? If not, and if we skip to the next slide, so if only one of them owns an additional dwelling, then only one of the buyers has to meet the conditions. So this basically opens up far greater flexibility for couples who are buying together but don't necessarily either both own dwellings or are in a position or have made a corresponding disposal of their old main residence. There is still one scenario in which joint buyers can be caught out, and essentially that is where they all own dwellings and they're living apart and don't form part of a single economic unit. They can still be caught and still have to meet all of the conditions separately and individually. And on to the next slide. I'm really going to rush through these now. So there are a few other minor changes. There's a new relief for inherited dwellings, which basically, or an exemption rather, basically if you inherit a dwelling in between the date on which you've concluded a contract to buy a new dwelling and the date on which you complete, that one, the dwelling that you've inherited won't actually be counted as an additional dwelling. You won't be subject to the charge on the new purchase. Unlikely to apply really, because in order to inherit the dwelling for the purpose of the legislation, you have to receive an actual conveyance, and it would be daft to end up in that situation if you were anticipating that you were about to purchase a new property. On to the next slide, and I'm just going to wrap up. They've improved the flexibility for couples who are separating. Basically, previously under the old rules, if you're separating and moving out of a jointly owned matrimonial home, you were potentially subject to charge on any new dwelling that you acquired because you retained an interest in the old property. There is now some slight flexibility in there that the property that you retain an interest in, which you've moved out of, will not count as an additional dwelling. But the sort of hard caveat there is that your ownership has to be retained in pursuance of a court order or actual separation agreement. Otherwise, you don't meet the conditions. And I'm just going to hand over to Bob now. There's one more slide, but we're running out of time. So if we skip forward, Bob's going to run through some cases in relation to dwellings.
It wouldn't be an LBTT ADS webinar without there being some new case law around the boundary between residential and non-residential property. And happily this time we have a Scottish case rather than an SDLT case. And this is the case of Ball and Torkoff against Revenue Scotland, which was released, the decision was released in November last year. And this case looks at a different bit of the definition of residential property to what the majority of case law has looked at. So the majority of cases about residential property and the meaning of dwellings that we've had in the last few years have really been concerned about the question of what is the garden or grounds of a dwelling, and when does an additional piece of property fall outside of that definition. So we've had cases looking at things like fields for grazing of animals and whether a whaley for a power line running across a garden makes the garden non-residential and things like that. This case looks at a slightly different part of the definition of residential property. And this is the part here, section 59(1)A of the LBTT Act. Residential property means a building that is used or suitable for use as a dwelling, or is in the process of being constructed or adapted for such use. And the tribunal's really engaged in the question of what does used or suitable for use as a dwelling look like. And there's a lot less case law on this than there is in these other questions. And the leading cases are SDLT cases, Bewley and Mudan. So it's nice, like I say, to have a Scottish case on this. Next slide, please. The case concerns the acquisition of a large property in Edinburgh called Babberton House. And a lot of the decision is made up of the timeline, so it's useful just to summarize some of the key events here. Babberton House was built in 1622 as a large residential property and was used for approximately 350 years as a dwelling, and was listed as a Grade A building of historical interest in 1971. Use as a dwelling was discontinued in the mid-1970s, and the property was left vacant and ultimately fell into disrepair. And then it was bought by an investment firm, Cruden, at the end of the 70s and converted into their head office. Cruden then used it as an office for about the next 40 years until they marketed it for sale in 2018. And at this point, it was internally laid out as an office. It had that 40-year history of use, and its planning permission and its use class were as commercial property. There were various offers made on it, but a large impediment to an acceptable offer being made was the commercial use class. And so in November 2019, planning permission was sought to bring it back into residential use. Finally, after various back and forths, the buyers Bull and Torikoff had an offer accepted for 1.15 million. And at that point in January 2020, the employees who were still working in the offices moved out. There was only at that point a sort of janitor / night watchman who had anything to do with the property, and Cruden had changed their registered office as well. The purchase didn't complete until mid or the end of April in 2020. And then from April to December, a number of renovation works were carried out. And we'll talk about what those were in a bit more detail. And the property wasn't ready for the buyers to move in until spring 2021. So we've got quite a few things going on there. We've got a long history of residential use, a fairly substantial history of commercial use as well, and then a set of reservation works that were carried out. If we go on to the next slide. In terms of the condition of the property, it seems from reading the report that while there were some fairly substantial works that needed to be carried out, these weren't really of a structural nature. A report was commissioned on the property, and amongst the findings were that there were kitchen and toilet facilities, albeit dated, possibly, case doesn't say, avocado colored. And these were designed for office rather than domestic use. So while there was a kitchen, it wasn't necessarily the kind of kitchen you or I would have at home. While there was electrical wiring in place, this was designed for office use, and that had to be replaced. There was some cracking in the ceilings of some of the rooms, which illustrated some structural problems. It was rated as a commercial property, so business rates rather than council tax were payable. All of the utilities were supplied commercially, and so those all had to be replaced. The internet provider was a commercial provider, and all the connective infrastructure had to be taken out for that and replaced with a domestic broadband supply. The boiler in the property was a commercial boiler, and they couldn't get anyone to service it, so they had to replace them with domestic boilers and enter into a new maintenance contract. And perhaps most importantly, part of the ceiling of one of the bathrooms, part of the floor of one of the bathrooms was now structurally unsound, as about 2 feet of an oak joist had been rotted away. And this meant that there was a risk of structural failure and the collapse of the ceiling in the lower room. If we move on to the next slide. In looking at whether this was residential or not residential, the tribunal looked at two sets of questions, and I'll try and go quickly so we have time for at least a couple of questions at the end. The first is this property used as a dwelling for residential purposes? And reading this, one of the things that comes through, and I think it came through in our other leading decision in Scotland on the resi-non-resi boundary, which is SLOS, is that the tribunal are really keen to take a very pragmatic view of these kind of questions, and they're not interested in sort of angels dancing on pinheads and making really fine distinctions here. Revenue Scotland argued that the property was used as a dwelling. The taxpayers argued that it was used as an office because there was still, at the effective date, a night watchman. The tribunal didn't like either of these arguments. They just said, look, from an objective perspective, no one was using this property for anything. The appellants weren't using the property as a home on the effective date. They didn't plan to do so for another few months. So that's clear that use as a dwelling wasn't satisfied. And it's clear that use as an office wasn't satisfied either. By the time the appellants moved in, the employees had been absent for more than a month. There was vacant possession of the property. The registered office had changed. So it is not the fact that there was vacant possession on the effective date that leads us to the view that it was not being used as offices, but it had not been used as offices for some time. So that's quite a telling statement, I think. The tribunal are not going to be drawn into, and I think are quite clear here, a sort of scintilla of time arguments that there was a brief period when no one was using the property because it was sold with vacant possession. That doesn't matter. What matters is that the seller had completely exited the property in advance of completing the sale. So the tribunal found there was no active use. The property was not occupied or in use for some time before or indeed on completion. And I think that is the correct answer. It's perfectly sensible to say the property wasn't in use. You don't have to be using it for something. So it doesn't satisfy the used as a dwelling test, but is it suitable for use as a dwelling? Next slide, please. So in assessing this, the Scottish tribunal really relies heavily on a leading SDLT case, which is Mudan. And there's a few important points in Mudan that the decision in Torokov really rests on. First, very clear, and this is taken direct from Mudan paragraph 45 of the decision, the phrase suitable for use as a dwelling is more likely to be focused on the fundamental characteristics and nature of the building than on a snapshot classification by reference to habitability at the effective date. In determining the fundamental characteristics and nature of a building, whether it has been used as a dwelling is clearly relevant. And in Torokov, the tribunal's kind of similar position is our starting point is to consider whether the essential characteristics and nature of the property were those of the dwelling, notwithstanding that it needed repairs and renovation. So they talk about essential characteristics here, but really what they're talking about is the history, I think, of the property and what that history supports. Next slide. And again, you see here, paragraph 129, the tribunal really relies on this long period of 350 years of use. And I think it's quite interesting, they say, the property clearly had many characteristics of a dwelling. And even though it had 40 years of use, as an office, this was comparatively short. They also look in the round, and this is another important point they draw from Mudan, that you have to consider the collective impact of any necessary works and think, do these works that are required either mean that the fundamental characteristic of the building is going to change as a result of doing them, or does it mean that the level of works required mean that there's no suitability for use? So there's two ways here that they consider the level of work required to a property that is in a state of disrepair could affect its dwelling status. Does that level of work point to the building being fundamentally something other than a dwelling, or does it make it fundamentally unsuitable for use as a dwelling? And on that latter, they also want to consider, and this was an important point in the Bewley decision, what risks do those works carry out? In Bewley, the property was riddled with asbestos, and so remedial works could not be carried out without extreme risk to the health of people carrying out those works. Another factor they consider is, would carrying out these works somehow undermine the structural integrity of the building as a whole? And if we slip on to the next slide, please. The tribunal are clear when they look at the work that's needed, and we referenced some of that when we looked at the report earlier. This isn't enough to fundamentally change the character of the building. None of the works that are being proposed are incompatible with works that would be done to a dwelling. So we're potentially talking about repair and renovation rather than significant alteration here. And they also do not think that the level of disrepair, such as the fault with the oak beam, renders the property uninhabitable or unsuitable for use. And that's important because they make the point, look, this is a big house and you're just talking about 2 rooms. That's not enough to render that building unsuitable for use as a dwelling. And there's nothing integral to those works that makes the property unsuitable for use, as there was in Bewley with the asbestos. So again, I think this is the tribunal trying to take a really pragmatic look and not get drawn into sort of abstract concepts here. And the lessons I take from this case are, number one, when you're looking at suitability for use, the tribunals will look and put weight on historical use and the ratio of historical use as a dwelling to other uses. And they're more interested in building a sort of rounded picture of the property than a snapshot of what it was like at the effective date. Second, just because you need to do some works doesn't mean that a property is unsuitable for use. You really have to consider the impact of those works as well. Another lesson here is that the presence of facilities, even though they don't look like what you might typically expect in a dwelling, were important in establishing the suitability for use. The tribunal does hone in on things like the fact there are a kitchen. I think their comments around vacant possession are actually quite helpful because similarly, they've closed the door, I think, or made it harder to argue if you are the revenue, that if you are buying a commercial property for conversion back to residential use, the fact that you're buying it with vacant possession, so the commercial occupier isn't in on the day, is not going to be a determinative factor. What was determinative here was the fact that they had been out of occupation for some time, not that it was vacant possession. So that is useful when you're having these arguments or trying to run these analyses of property. And I think we also have to consider the question of, would use as an office at the effective date be sufficient if the property still had the essential characteristics of a dwelling at the time, and would this make it suitable for use? I think if there was, I think this is something that's going to be marginal in a lot of cases. If you look at a lot of Edinburgh offices that are effectively converted townhouses, I think it's the level of conversion, and as the tribunal hones in on, the level of works and also how long that use has been in place. So to summarize, I think this is a practical decision by the tribunal. I think they've done a good job here. I think it's quite a realistic appraisal. And the other thing I would just say, I know they're not interested in sort of abstractions. They do use the slightly metaphysical sounding phrase, the essential characteristics of a dwelling. I do not think they mean this in any kind of sense of Platonic forms and, you know, what is a dwelling in the abstract. I think what they are trying to do here is to say, look, if you look at this building, it's usually pretty obvious if it is or was a house. And that's something you can just tell by looking at the nature of the property, by looking at what is in it, how it's laid out. You know, this is not meant to be a sort of highfalutin exercise in statutory analysis. So I think that's something to be aware of, something to take away, and being aware that when we are looking at properties which are not necessarily in residential use or which may be a little bit derelict, the analysis we have to do to work out what the right rates of tax are have to be, they can't be superficial, and we can't just focus on what the building is at the effective date in a snapshot way. Now, there were some questions in here, but I think we'll be picking those up by email. Sorry, we have run over slightly. We'll close now, and as I mentioned at the beginning, if people could please just take a moment to fill out the questionnaire, and we will take that feedback on board. We really do value it. If you have submitted a question, that should come through to us as part of the pull through, and if you've added your name against it, we'll try and come back to you by email instead. Thank you. Bye.